Good morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar. Traders, this video is being filmed on Wednesday night for Thursday's trading. That's August 20th, 2009. In last night's video, we left a message for you on the board, and it was buy the dips this week. Make sure you buy the dips as they happen. Last night, luckily, the market dipped enough for us to get in, and so far so good. It looks like the dip is holding. So tonight I am here to say continue to buy the dips and follow the analysis that is on the charts and not your biased, usually angry opinions. And what I mean by that is a lot of traders write on my YouTube these angry opinions. Oscar, are you blind? What do you watch CNBC and repeat what they say? Don't you see when a market's breaking? The government did this and the government did that, and you know what? That's all opinion, and it's got nothing to do with where a market will go technically. But what it does do is it biases your thoughts. It makes you think, oh, there's no way the market could go up because the Fed is crooked and China's crooked and Europe is not doing the right thing. Car companies shouldn't be going up. It's all a big lie. Well, you know what? When you come up with these opinions, that's your own paranoia, probably excuses you're making for why you lost money, and it is certainly not you following your analysis. We are technical analysts. We follow the technical analysis that comes off the charts without an opinion. With that in mind, to be honest with you, my opinion was, boy oh boy, I think it could break down. But once I did my homework on Wednesday night, I said, well, doesn't matter what my opinion is. The homework says absolutely not. If in fact the Nasdaq pulls into a certain level and holds, you have to get long and expect the market to now start heading back up again. We have been in a bull market since March 6th. We had a couple of days pull back and the whole world goes berserk. It's the end of the world. We're going to take out the March lows. Oh no, here comes the big crash. And I look at the analysis and say, boy, I'm going to stand pat and fight these people because I don't think they're reading the charts. I think they're using their own angry, biased opinions. And you know what? Even if you're doing your homework, looking at a chart, drawing some trend lines, looking at some indicators, if on top of that you have a biased opinion and you know the market's going down because the government is crooked, blah, 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 well, you know what? You're going to find 1,000 reasons in your analysis to point to the downside. If you can somehow control your emotions and push aside what you think and literally read the pure analysis for what it is, well, then maybe you'll see a clearer picture. Most people make bad decisions when they're angry because anger is an emotion, and emotional decisions usually don't work out for the better side of things when you're trading. So try to keep your opinions on the shelf when you do your homework. Do your homework off the charts, come up with a trading plan, write the plan down, and then trade the plan the next day without your own opinion involved. I am telling you, I've been doing this for many, many years. It took me quite some time to realize what the flaws were in my trading. And in the beginning of my career in the 80s, it took some time, as I said, but I realized the biggest flaw I have is I come in with this notion in my mind of what the market should do, even though I've done homework, and the homework says the opposite. I follow the homework, I follow the analysis, and way more often than not, traders, I am right on direction of where these markets are going. Do yourselves a favor, try to emulate that sort of behavior and keep your emotions out of your analysis. All right, traders, what we are looking at for tomorrow being Thursday is the Nasdaq pulling up, the S&P pulling up, the transportation average, the Dow Jones Industrial Average, the FTSE, the DAX. We expect the whole package to move higher. We also expect the euro currency to move higher and the US dollar to move lower. 2 videos ago this week, I said to you there is a relationship between dollar index and euro currency, and together there is an opposite relationship of what the stock market does. So if you gauge the currencies and then gauge the stock market, you can basically build a picture. And I said, if the euro can get itself above this wedge that we're in, it will push the dollar down and take the stock market higher. Well, that is exactly what's going on right now, traders, and I'd like to show you that on charts so that you can see it for yourselves. Let's go look at some charts. Okay, traders, the first chart you were looking at is the Nasdaq daily bar chart, and it's a chart that I showed in a class today. I also showed it last night on the EMini, and I mentioned that this was a do or die area and that we are buying this dip. Why do I call it a do or die area? Well, you have a channel which is parallel, and parallel channels are relatively strong and can be relied upon. You hit the channel here, you rally up and hit it here, you come back down, you bounce off the channel. Rally up, hit the channel again, come back down, bounce off. Then you have this little drop out of the channel, but it doesn't last long, and a major rally comes out of it, straight up. You go to the top of the channel, and then we start working our way a little sideways and back down. And my work says, of course, when we hit this channel, we need to get in. It's a do or die area because if you break out of the channel, then likelihood is you can break down a little, but this is what you would consider a bull market. If this is a bull market, you are buying these dips, not selling into them. So that was my reason why I was steadfast this whole week as the market pulled back. I stuck to my guns and said we are buying dips. This is one of the reasons right there that I was convinced it would work. This dip worked, this dip worked, this dip should work. There's no reason why it shouldn't. So there it is, traders, a parallel channel. Indicators are all pointing straight up right now. Pull your indicators and look for yourselves. It's the same on the Nasdaq as it is on many of the world's indices right now, as far as indicators are concerned. So take a look at what we're looking at. Again, traders, lesson to be learned. If you are working inside of a parallel channel and it's working well, don't listen to the news. Don't listen to the panickers. Certainly don't listen to the angry opinions out there. Do your homework and follow your analysis. The analysis is pure. It is unbiased. It has no opinion. It's got no mortgage to pay, no BMW payments, no ex-wives. None of that exists in the analysis. It does exist in people's minds when they try to figure out what to do. Keep your thoughts pure. Follow what it says on the charts. Follow your indicators. And I think you will have a much better chance at calling markets correctly. So traders, that's the Nasdaq. Now I want to show you that euro currency because there is a relationship between the Nasdaq and the euro. Of course, the euro and the rest of our indices. And I want to show you that they both set up at the same time, and you're supposed to go with the both of them if they set up. Let's take a look. Okay, traders, you are now looking at the euro currency daily bar chart. During this week, I posted on my site, showed in a class, and mentioned on the EMini this very same chart. I showed this wedge formation, and I showed that if, or I should say I mentioned that if we get back into this wedge, we become very bullish because the market got a little bit below it for a day. Well, Tuesday, or I should say Wednesday, it shot straight back up. And if you look at this now, traders, a nice bull flag formed. Here's your flagpole. Here's your bull flag. The next thing should be a blast-off rally out of the top of that flag and up for new highs, especially if we can take out the top trend line of this wedge. It's an ascending triangle or a wedge. I just call them wedges because it kind of takes all the ascending and descending angles and puts them into one box, a wedge. When you see a wedge, you respect the bottom of it and the top of it. Whatever side gets taken out usually will turn out to be the winning side. There's more to watching a wedge than just that, however, traders. There's also this thing that I call the 65% false breakout, but that's another lesson completely, and I can give that to you if you come on down to my site. It's www.livewithoscar.com. I'll be more than happy to show you the 65% rule and why we use it as often as we can. Turns out that the 65% rule at this point, I don't know if it's going to actually hold true, but it did give us our flag, and that is what makes me happy. A bull flag in a bull market, and at a moment where it was running down for a few days, dollar was running up, the S&P was running down, the panic started beginning in the streets, and boom, it hits a trend line, turns right around and heads back up to complete a flag. That's a bull flag, and I like the fact that it's there. I'm expecting euro to move higher. Now I have just one indicator to show you on the euro. There are several, I should say 10 to 12 indicators that I've pulled. They all look very good. I'm just going to show you one. Let's look at the indicator. Okay, traders, you are now looking at the euro. Once again, daily bar, but this is a slow stochastic. It is an indicator that we like to look at to gauge direction. And as you can see, it is now pointing back up. It had a couple of down days as the market did. Wiggled a little bit, put a double-legged bottom in, and it is now working its way back up and is holding a little trend line here, which is nice. So, indicators pointing higher. Pull the rest of your indicators on the euro and on the indices, and you'll see that they are pointing higher. If you pull a dollar index chart and pull the indicators on that, you'll see they're pointing lower. And that means we should move up in euro, down in dollar, and that equates to an up market in the indices. Now, there is news coming out tomorrow morning at 8:30. I would imagine the news is already built into the charts, and the news should be buoyant for the stock market. We shall see. I always believe the news is in the charts first. The charts turn today. The news comes out tomorrow. Let's see if it does hold true. So, traders, you see those charts? You see the analysis behind them? I think I like what I see. That parallel channels really do work well. You know, how many videos do you think we've done where we've illustrated how well parallel channels work and they did the next day? You have anybody?
Lots.
Lots, right? So many that we can't count them, and they work almost all the time. Then if you fall out of a parallel channel, it becomes resistance, which was support. So use your parallel channels, draw them correctly. You got to come across at least 3 tops and 3 bottoms. You can't fudge them and make them fit. You got to have them naturally fit on the chart, otherwise they're not parallel channels. So don't be fooled by curve fitting what you want to look at. Just make sure it just fits. You put a parallel on it and you go, wow, look at that. It hits 3 tops, hits 3 bottoms. Then it's probably a good channel. Don't just slap them on the chart and force them to fit. I don't do that. I don't recommend you do it as well. But parallel channels do work well. Make sure you use them. And the inverse relationship between euro currency and dollar and euro currency lately in the stock market is there. That relationship doesn't always hold, traders. There are times where the S&P and the dollar will move in tandem and times where they're opposite. We are in an environment right now where they are opposite, so expect opposite movement between dollar and S&P. All right, traders, remember to keep your opinions on the shelves, especially these angry opinions, because I'll tell you what, most of the traders that come and attack our videos are the traders who are so angry and pent up about what the government did, they can't even see where the markets might actually go. They can only see what they think might happen. And I'll tell you what, traders, we're human, we're all wrong. The markets are right, they're right 100% of the time. As humans, we can't guess. We need to use analysis, and that's about the only form I have found in almost 28 years of homework that actually points me in the right direction more often than not. So again, do your analysis as pure and simple as you can do it, and believe in it over your crazy opinions. All right, traders, make sure you give us a call anytime day or night, 702-629-4755. Get your butts down to the Omni Trading Academy. Jump into the chat rooms. They are free. Grab a free membership. I give free lessons throughout the week. I gave one today, which illustrated a lot of the work that I showed you here, but in much more detail, in-depth, and interactive. So make sure you come on down for the classes and keep your emotions out of trading at all times, traders. One of the best things I can do is tell you to say this to yourselves every morning, every afternoon, every evening. And you know what that is? Stops are in. Emotions are out. Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I'm a 27-year seasoned trader on and off the trading floors. This is how I've made my living for many, many years.